Is your organization a digital credit provider? Here are the top 5 ways your company may be violating the data protection principles. Let's start with a bit of background. Digital credit providers means any person or business that provides loan services through the internet, mobile services, or other digital systems as prescribed by the Central Bank of Kenya. Digital lenders, like any other sector, are prone to violate data protection requirements. In this video, we focus on violations related to data protection principles. We'll specifically cover the top 5 ways in which digital lenders violate data protection principles. Are you ready to dive into the 5 areas? Then let's start. The first violation is purpose limitation principle violation. Digital lenders collect personal data from their customers for purposes of processing their credit ratings and confirm whether or not to give the applicants a loan. However, there are times when digital lenders use the customer's phone numbers and emails to advertise new products or services without informing them that advertisement will be part of the service offering. This is a violation of the purpose limitation principle because the original purpose for collecting the phone number was for loan purposes strictly and not any other purpose whatsoever. The second violation is data minimization principle violation. Digital lenders collect personal data such as the name and address of the customer as part of the onboarding process. Sometimes providers require you submit additional information like family members or religious belief. Requiring users to submit these additional data is a violation of data minimization principle. It is in no way useful in the process of lending money to the customer. The fourth violation is accuracy principle violation. Let me start by asking you this. Has your organization ever sent threatening messages requiring a customer to repay a loan, only to find out that the message was sent to a wrong number? Well, it's a violation of accuracy principle. It often happens when an organization fails to maintain accurate records of a customer's personal data that results in information being shared with the wrong person. Inaccurate records can also lead to errors involving loan recovery where a customer has fully repaid credit offered to them, yet threats are still sent to them. Number 4 is storage limitation principle violation. This one is a tough one. Mobile lenders typically want to analyze trends, which often involves dealing with large volumes of data. If there are storage limitations, it may be difficult to store and manage the vast amount of information required for comprehensive trend analysis. Our fifth and final example is integrity and confidentiality principle violation. Let's take Nancy, a young professional who has decided to explore the convenience of mobile loans and chose Money Chap Chap mobile app. As she fills out her application, she enters personal data including her ID number, salary details, and bank account information. This is where the principle of confidentiality comes into play. Confidentiality ensures that Nancy's personal data remains shielded from hackers and unauthorized eyes. If the organization is hacked and Nancy's details are leaked, or say an unauthorized employee looks into her details, this will amount to a violation of this confidentiality principle. Let's also say that a few months down the line, Nancy is feeling financially buoyant, decides to repay her loan ahead of schedule. She logged into the app, keyed in the repayment amount, and hit pay. This action brings the principle of integrity to the forefront. Integrity ensures that Nancy's repayment amount remains unaltered and accurate during the entire process. Digital lenders should employ mechanisms like checksums to verify the accuracy of the transaction. If, due to a software glitch, the amount Nancy entered were to change during processing, it would be a glaring violation of data integrity. That's it! Follow us on www.scratchandscript.com for more.